1 million billion Vietnamese dong. That's the staggering sum of new credit poised to flood a key Asian economy, a financial injection that few on Wall Street are even tracking. While the mainstream investment community obsesses over whispers that OpenAI might delay its landmark public debut, sending jitters through the tech sector and directly impacting bellwethers like Micron technology, savvy traders need to look further afield. This massive, under-the-radar move in an emerging market isn't just a regional headline. It could fundamentally reshape global capital flows, creating an unexpected, yet significant, opportunity for those watching Micron stock right now. It's about spotting where liquidity is truly moving, not just where the immediate headlines are.
For weeks, every major financial outlet, from Bloomberg to Reuters, has fixated on the swirling rumors surrounding OpenAI's highly anticipated public debut, specifically the potential for a significant delay. This speculation alone has sent noticeable ripples across the tech landscape, directly impacting major semiconductor players. Micron Technology, for instance, has seen its stock dip in response to these perceived headwinds. Yet, what's often critically overlooked in these moments of short-term, sentiment-driven volatility is the broader global economic tapestry, particularly how significant capital is being strategically unleashed in rapidly developing emerging markets. This isn't merely a story about a single, influential tech giant's immediate timeline. It's about deeply shifting global liquidity, evolving investment priorities, and where the most astute capital might truly find its next high-growth home, away from the immediate tech-centric noise. Here's the concrete data that most investors are unfortunately missing amidst the pervasive tech sector's jitters and the OpenAI news cycle. Robust estimates from VCBS, a highly respected financial institution in the region, project nothing short of a colossal expansion of credit within the crucial Vietnamese banking sector. They have precisely highlighted a potential increase of 1 million billion Vietnamese dong in available credit, a staggering sum driven by a strategic and decisive regulatory decision to proactively raise the short-term capital ceiling for critical medium and long-term loans. This isn't a mere theoretical proposal. It represents a concrete, implemented policy shift specifically designed to inject profound liquidity directly into the real economy. Moreover, small and medium-sized banks are unequivocally poised to be the primary beneficiaries, indicating a broad-based economic stimulus. Consider the profound ripple effect. This substantial capital infusion could fundamentally alter regional investment landscapes and attract global capital seeking growth. What's truly astonishing, and frankly, a significant blind spot for many, is how little sustained attention this massive credit expansion receives in dominant Western financial discourse. It holds the potential to indirectly, but powerfully, influence global tech valuations and broader capital allocations. While the market reflex is to react sharply to whispers about OpenAI's potential IPO delay, creating a noticeable, albeit transient, dip in fundamentally strong stocks like Micron, truly smart investors are looking strategically beyond these instant headlines. A significant surge in regional liquidity, precisely like the 1 million billion dong projected by VCBS, inevitably frees up substantial capital. This capital will eventually seek higher, more diversified returns globally, including in robust, innovation-driven sectors such as semiconductors. The perceived fall in Micron due to an IPO delay might just be a transient blip, a pricing anomaly when you accurately consider these larger, underlying global capital shifts at play. For those prepared to decisively seize the moment, this current valuation could be the strategic entry point many have patiently been waiting for. Don't let the pervasive short-term noise drown out the clear, long-term signal. Subscribe to stay critically ahead of these crucial, often missed, global market dynamics.
Leading strategists at JP Morgan are now weighing in, suggesting this wave of Asian credit expansion could re-rate several overlooked financial institutions. They point to a potential 15% upside for certain regional bank stocks within the next 6 months, completely separate from the Silicon Valley narrative. What's more, analysts at S&P Global are revising their forecasts for regional GDP, citing the potential for robust domestic demand fueled by accessible capital. They argue this policy shift is more than just a liquidity injection, it's a foundational recalibration of economic support. Even Reuters has picked up on the sentiment, quoting economists who view this as a deliberate move to de-risk smaller businesses and foster homegrown enterprise. It's a compelling counter-narrative to the prevailing tech volatility.
Beyond the immediate borders, this policy ripple is already being felt across interconnected markets. Major trading houses in London and New York are adjusting their emerging market portfolios, recognizing the potential for increased trade finance and cross-border investment. We're seeing a discernible uptick in institutional interest for Asian fixed income, as yields in the region become comparatively more attractive. The move is also drawing comparisons to earlier regional growth surges, prompting a reassessment of supply chain resilience by global corporations. Firms like Apple and Nike, with their extensive Asian manufacturing footprints, could quietly benefit from a more stable and credit-rich local economy, regardless of direct tech sector performance. It's a subtle but powerful shift. Recall the post-dot-com bust era, specifically 2002 to 2004, when the U.S. Federal Reserve aggressively cut rates and injected liquidity to restart a sputtering economy. While the scale and geography differ, the underlying principle of stimulating lending to bolster Main Street mirrors today's Asian policy. Back then, it wasn't the high-flying tech stocks that led the initial recovery. It was the financial sector, consumer discretionary, and industrials. Banks, suddenly flush with cheaper capital, extended credit that powered a broader economic rebound. Whoever studied that cycle understands the long-term compounding effect of accessible capital on non-speculative growth. This isn't just about a stock price, it's about economic architecture.
Unsurprisingly, local financial institutions are positioned to be significant gainers. Think regional banks and credit unions, often overlooked by international funds fixated on Wall Street giants. These players, with newly expanded lending capacity, can capture market share from larger, more rigid competitors. But here's the twist. The real indirect winners could be small to mid-cap consumer goods companies and infrastructure firms in the region. They'll find borrowing cheaper and easier, fueling expansion and project development. On the flip side, some international banks with less localized operations might struggle to compete, facing tighter margins as local lenders gain an edge. It's a rebalancing act, not a rising tide lifting all boats.